confusion with taxes and real estate. We are just going to try to clear that up. So when I'm talking to my clients these days, whether they are buying their first home or trying to buy their investment property, or even they bought their first home and are trying to grow, get into an upgraded property to the next one. Every time I get similar questions. The first thing is, most of the property websites that you see do not put out the tax related data. And tax is such an intrinsic part of owning real estate that you cannot be there without understanding. You cannot buy a home or sell a home or buy an upgraded property or buy an investment property without understanding the tax consequences. And in each of these cases, these work out differently. And that's what we are going to talk here today. So, when you're buying your primary home, there are only two deductions available on a monthly basis. And then there is the capital gains tax when you are selling the property. So these are the benefits, or these are the taxes that you will get charged when you are buying and living in your primary home. So the first thing that you will be seeing when you are buying your primary home is that each month you can get, based on the current rules, each month the interest on the first $750K or $750,000 of your mortgage is going to be tax deductible. So if you're buying a property that's $500,000 and you have a mortgage of $400,000, you will be getting a tax deduction on the interest that you pay on the $400,000. Now, if you can afford a house much bigger than that, afford a monthly payment of say $1 million, then your mortgage will be about $800,000. Then the interest that you pay on the first $750K is going to be tax deductible. The $50K of the $800,000 mortgage will not be tax deductible. And you will be getting a tax break based off of that amount at the interest rate that you're currently paying. And generally, this gets reported on your 1098 at the end of the year. So that's how that one works. The second tax break that you get on a primary home is your property taxes. But remember, property taxes are tax deductible only up to a $10,000 limit. Now, also, these are called as state and local taxes. So say in California, if you have a car, the taxes that you pay on the car could be deducted against as taxes paid to the state. Same way, the property taxes would be deducted. And so, if you already hit that $10,000 limit, that is what is called as the state and local taxes, or SALT cap, which is cap is $10,000. So at the most, the deduction that you can take is $10,000. So that's the second one. Again, I am not a tax consultant. All these are your tips to go and discuss with your tax consultant. We are not supposed to be advising on tax matters, and these are just some items that you should be taking with your tax consultant and actually using them in your taxes. And that's the key. This is for full disclosure that this is not tax advice. You just need to keep these points in your kitty when you are going to file your taxes or talk to your tax consultant and see how much home you want to buy and how does it work. Now, The next benefit that you get out of home ownership is a 250K gain when selling the home on capital gains tax. And that 250K gains, $250,000 gain, can become $500,000 if you are married filing jointly. So for single, it is $250,000. For married filing jointly, it is $500,000. So notice that there is no such benefit when you are investing money in stocks. I mean, sometimes I joke with my clients and I say, guys, it is better that you buy and sell your home every time your gain hits the $500,000 number and go upgrade. Because A, you're getting this $500,000 tax-free, and B, you're upgrading your home to the next one. $500,000 of income tax-free. Go play with stocks, mutual funds, and any of those, and I don't think you can find this kind of a benefit going in that direction. So that's the second one. Now, the one confusion that I saw people having is they said, oh, I thought if I sell this home of mine and go buy my next one, I'm probably going to get to roll the entire gain into my new home to buy the new home as a purchase price. And that's completely incorrect. And that's the confusion. I mean, I've been dealing with these confusions so much these days that then I decided that I must do these videos giving you the information so that you're better equipped when you're actually going to do your buy, sell, or upgrade transactions, or buy even an investment property. Now, investment property, that's a completely different treatment given taxes. In case of investment properties, your entire interest, no caps, your entire property taxes, no caps, your entire property management expenses and maintenance, all of these items are tax deductible. Additionally, the HOA that you pay is also completely tax deductible. Not just that, you will also be able to deduct the depreciation on the property. Now, you will say, oh, interest is my expense, getting it deducted, no problem. Property taxes is my real expense, I'm actually giving the money away. Great, no problem. Maintenance, of course you spend on maintenance. And property management, if you have one, you will spend on it. And HOA is a real expense. But the depreciation is not a real expense. So say for example, I have a property which is currently getting me a $10,000 in rent. Out of the $10,000, my mortgage payment is about $3,200, say. Out of that $3,200, the interest that I pay is $1,500. The rest of the $3,200, $1,700 is currently going towards principal. So $1,500 in interest. The property is currently worth about $3 million, but that property, say, has property taxes of, because the purchase price was about 1.3, the property taxes are about based on 1.6 million. So let's assume those are about $20,000. So of the $20,000, each month I am paying about $1,600 in property taxes. So $1,500 for mortgage interest, $1,600 for property taxes, so that's $3,100. About $500 for utilities, water and electricity, so $3,600. And then I have no property management on that one. And so after $3,600, the rest of the $10,000 just come to me. But Because I can take depreciation of about $30,000 per year, I am able to deduct $2,500 from the property, from the income each month. So $3,600 plus $2,500, how much am I getting out of depreciation? $6,100 total. So that $6,100 total is deductible. So I'm probably paying taxes on only $4,000. Now, what is good about this is that in spite of taking home $10,000, but paying $5,600, I'm actually able to keep $4,600 at home without paying taxes. So that money is covered by depreciation, and so I don't have to pay taxes on that. We don't get these kinds of benefits even though we make so much money or transact in other cases. Then additionally, when you sell this investment property, you get to carry the entire gain to the next property. Try doing that with your highly appreciated Nvidia stock. Sell it today and try to buy the next stock and show me that you don't have to pay capital gains on it today. Every time you sell or buy a stock, particularly sell, you are going to pay capital gains taxes. And in real estate, if you roll that into another one, you don't pay capital gains taxes. It continues to roll and go as long as you keep that money invested. There are lots of other advanced strategies. You should click subscribe and watch my videos regularly. That should give you more ideas. I will be talking more about taxes, strategies, and confusions so that you get to understand and play the real estate investment game very well. You know what? You will save not thousands, but hundreds of thousands of dollars by using the correct strategies with real estate. I hope this was helpful. See you on my next episode. Bye.